You're watching Mint Deals of the Week, where we'll tell you about the latest happenings in the startup community. Here's what's coming up on the show. We talk about how some budget proposals could make M&A deals expensive. And a chat with Canaan Partners MD Alok Mittal on his expectations for this year. Now that the union budget this year left a sour taste with India Inc., we'll take a look at how certain proposals could make M&A deals more expensive. My colleague Dipti Chowdhury joins us from Mumbai to tell us more. Dipti, tell us more about these proposals and how they could make M&A deals more expensive.
Vaishali, there is a proposal in the union budget according to which all services that fall outside of the purview of the negative list will come under service tax. Service tax is about 12%. So far, the negative list included services like ambulance and shadi pandals. However, the service tax is now going to impact mergers and acquisitions and buyout deals in India. All these kind of deals have certain clauses common to them, like non-compete fee, non-solicitation fee, and escrow accounts. Out of these new proposals, all these services can be taxed for service tax, which will imply that any promoter will have to pay a tax of 12% on a transaction.
Okay, so that means having a non-compete clause or a non-solicitation fee or an escrow account as part of the M&A deal could attract a service tax?
It could, because these are the clear implications of the proposals. Also, it will depend on how your tax manager looks at it.
Okay, so a lot of it is left up to interpretation.
Yes, a lot of it is open for interpretation. In fact, if I tell you what a lawyer is telling me, it's sort of very interesting. According to lawyers, these deals can actually be restructured in a manner that the valuation of a company can go up, and what really is left in terms of, say, a non-compete fee can go down. So a promoter can actually work around with these mechanisms and pay less for say, a non-compete fee.
Interesting. How much of an impact do you think this will have on the M&A industry? Do you think it could impact the number of deals that actually happen going forward?
It would be a bit too much to say that this is going to bring down the number of M&A deals, but a very obvious impact is going to be on the valuations. So the deals are going to become expensive for sure.
Okay, thanks for joining us, Dipti. And moving on, Alok Mittal, Managing Director of Canaan Partners, joins us to tell us more about the latest trends in the market and what his expectations are for this year. Alok, tell us how the VC arena is changing with new funds and new money coming in.
So venture capital is about a 5 or 6 year old industry in India. About a dozen funds started between 2006 and 2008. And by and large, those are the funds which are investing in early stage in India today. So new entrants after that haven't really come forward because they're waiting for these funds to perform and see whether India is a viable venture market or not. However, last year there were two other pools of capital that came in. One before the venture stage. So a lot of angel funds came up, seed funds came up, and that's a positive news because they tend to create a pipeline that venture investors can then go behind. And more interestingly, some of the growth funds, which classically would invest in profitable companies, came and became a viable source of follow-on financing for venture-backed companies. So Series C, Series D financings, we saw some of the growth players participating in those who would earlier have never looked at venture portfolios as an investment class. So I think the ecosystem is getting more filled up without necessarily there being too many players coming into the venture class itself.
And beyond e-commerce, what other sectors do you see gaining traction this year?
So consumer internet broadly is of interest to us, not just the e-commerce bit of it. So we think there is significant value in services side of internet, transaction-enabled services. We also think that the mobile industry is going through a significant transformation and there will be investment opportunities behind those. So if you looked at the mobile VAS industry 3 years back, it was all SMS and voice, it was all operator intermediated. And that had its own benefit in terms of quick scalability, but also challenges in terms of revenue shares and payment cycles, marketing to the consumer and so on. Some of those walls are beginning to come down. And with the advent of app stores, with more smartphones, large screen sizes, it has become viable for companies to go and directly market to consumers.
Okay, can you talk about any other trends in the kinds of companies that are being started?
We're beginning to see more and more software companies. Again, that market, in our view, has been underdeveloped, largely because large enterprise customers don't necessarily look to startups when they're buying software. But we're beginning to see some of the companies come up and start scaling on that. Notably, a few companies that are beginning to succeed in terms of creating software for global markets, not just for the Indian market. So I think this whole notion of SaaS businesses which can be delivered over the web, but more importantly sold over the web and telephone, that's beginning to get some traction. So that's an interesting space we're watching out.
Okay, can you talk about some of the investments that Canaan has made in India?
We've been in India for about 6 years now. We've got 12 active companies. The ones that we invested in the first couple of years of our India entry, 2006, 2007, some of them have scaled up very nicely, right? So Bharat Matrimony is now the clear leader in the online matrimonial classified space. iYogi is the largest direct-to-consumer business out of India, targeting the global markets. UnitedX is a leading legal services provider for global markets. We just raised our 9th fund. It's a $600 million global fund, which we will again invest in US, Israel, and India out of. So we are looking at making fresh investments. Our usual deal pace has been 2 to 3 investments a year, early stage, technology-oriented companies, and we'll continue down that path.
Okay, so when exits happen in the industry, who's acquiring them?
On the internet side, we've started some M&A activity, within the local players. Recently Flipkart acquired Let's Buy. Prior to that, a few years back, the company I founded, JobsNet, was acquired by Monster. Bazi was acquired by eBay. So there has been some precedence. However, all of these are relatively small transactions, right? Less than $100 million in value. So I think that space is still fairly sparse when it comes to large acquisitions and stuff on which VCs are really going to make money rather than just about get their money back. And on the mobile side, again, we've seen on the value-added services relatively few transactions, largely because none of the Indian players really have the currency right now. So I think what we'll see is 1 or 2 or 3 players go public, create that pool of equity, and then use that to consolidate the industry.
And tell us how you see the industry evolving over the next 5 years.
The current class of VC players in India are all people who started 2006, 2008 timeframe. And essentially, none of us really have fund level returns at this point in time, right? All of us have some exits to show. But other investors are currently waiting and watching to see what does this class deliver, right? And if we deliver on the returns at the fund level, I think there'll be a far greater interest in other funds coming to India, both at the level of venture funds, GPs, but also limited partners who want to invest in such venture funds. And I think that jury is out right now. It'll get probably answered in the next couple of years of whether India is a viable venture market or not.
So it's actually a pretty exciting time to be in this space, right, in its early stages.
Because we've seen the entrepreneurial activity just gain a lot more traction over the last 4 or 5 years that we've been around. Right, so I think this is an ecosystem development phase where entrepreneurs realize there's capital available. So more and more of them, more experienced entrepreneurs, are now willing to come out of their jobs and start businesses. Talent is beginning to join companies because they have seen success stories of making money through ESOPs. We're seeing a network of advisors and mentors develop. So all of this is happening simultaneously. It's fascinating to see some of that.
Okay, thanks for joining us, Alok.
Thank you.
And that's it for today. We'll see you next time on Mint Deals of the Week.